it. I'm really excited to welcome you today to the Economic Development Finance Summit. We know you all are busy moving the economic needle in your communities and states, so we are so appreciative for your here today to talk through finance concepts, tools, programs, and practices that are imperative to economic development success. So today's summit is a core element of the SEDC Professional Development Initiative, which is a 2-year series of courses, about 20 to 25 topics that are delivered via educative webinars or in-person forums on the front end or back end of our conferences. And these are designed to enhance professional capacity to accelerate economic development in the South. So everyone on this webinar is now engaged in that program. So we hope that you continue on through the weeks, months, and years ahead. And today's course is a special one because we have also made this event part of the SEDC webcast series. So hello to all of those in the future from now who happen to be watching this online. We hope you are enjoying the SEDC webcast. So I say this all the time, but you all know that when SEDC seeks to talk strategy, capacity building, or education at these forums, we know that there are no better speakers than SEDC members and partners, because it just is what it is. You all set the bar, you set the professional standard in our industry, and you have built the South into the global powerhouse that it is. And more importantly, you're crafting the future of economic development in the world's 3rd largest economy. So we love to bring our members together here at these forums to learn with one another, to interact with one another. And as we move forward today, when you're hearing from our special guests, please feel free to drop questions, comments, or anything that you'd like in the chat or the comment bars. So we are really thankful today to have you all here. We are excited for, this is an important session, and I'm equally excited to get out of the way and to introduce the real experts, our special guests, to talk economic development finance. So first, we have Dr. Jessica Dunn. Dr. Dunn is an assistant professor of finance in the Arthur Bauernfeind College of Business at Murray State University. She earned her doctorate in finance from Southern Illinois University in Carbondale. She holds a Bachelor of Science degree in mathematics and an MBA from Murray State University. She has earned additional certifications in economic development, including Economic Development Finance Professional, the EDFP. Dr. Dunn has begun her teaching and research at Murray State University in 2013. She has taught various courses, including Economic Development Finance, Corporate Finance, Management of Business Finance, Professional MBA Corporate Finance, and Principles of Finance. Her research interests include corporate finance, banking, and executive compensation. Dr. Dunn is also a big part of economic development education in the state of Kentucky, including in that state's BEDC courses, where she and I have worked together for some time prior to me coming to SEDC. So today we also have Chuck Whipple. Now, Chuck needs no introduction here. Chuck is a longtime SEDC leader. He's previously served as chairman in 2016. Everyone knows Chuck. He currently serves as vice president and director of business development at ECS, which is a multi-state 2,500 employee leader in geotech, construction materials, environmental, and facilities engineering. And they are also a great partner to SEDC, as we all know. So prior to ECS, Chuck served as executive director, Enterprise Campus Authority and Economic Development at Midlands Technical College. And he also held local and state economic and workforce development roles. Now, prior to those roles, he was in finance and banking in South Carolina. So we all know this. Chuck's a mainstay at SEDC and organizations like this. He is also on faculty at OU-EDI, where he focuses on a myriad of items, including economic development finance and credit analysis. So overall here with Chuck, I hope you don't mind me saying this, but we've got 43 years worth of experience and knowledge here today. So with that said, thank you, Dr. Dunn. Thank you, Chuck. Welcome to the webinar, the Professional Development Initiative. Welcome to the webcast, and the floor is yours.
Thank you so much, Matt. We're happy to be here. I'm sure I can say that for Chuck as well. We're just going to be covering economic development finance today. And I am a professor, so I get used to lecturing, but I hope that it's a discussion. So if you have anything to say, feel free to do so. Chuck, is there anything that you'd like to add?
No? Jessica and everyone on the podcast, thank you so much for having me. I'm looking forward to sharing some tidbits of credit and banking and the impacts that it has on economic development. So looking forward to the discussion.
Okay, well, we'll just get started then. Everyone's ready? Let me see. Okay, so we're just going to basically start here with the goal of economic development. Economic development, we're concerned with improving quality of life and well-being within a community. And there are several ways this can be accomplished. So first, the best way is to stimulate private sector investment. The private sector is important for generating tax revenue to create better life, creating jobs, innovation, new products and services. And the private sector is where the money is. A community cannot sustainably invest without growing that private sector investment, primarily to grow the tax base. The second would be to create and retain jobs. Job creation and retention improves community satisfaction and happiness and reduces worry. Because what happens when you're worried? Obviously, you get scared, you don't invest, you don't take as many risky projects as you necessarily would have. And so cash is hoarded. And so if we have job creation and retention, then we're going to have more spending, healthier businesses, and again, more tax revenue. A third goal would be to increase productivity. We need to supply businesses with what they need to increase their productivity, whether that is training or education or even money for increases in working capital. Grow the tax base. Obviously, success breeds success. That's the story all the way through life. One success leads to another success. So more business activity and higher paying jobs means more taxes. More taxes means there's more money available to stimulate the private sector. That leads to better infrastructure, better quality of life, more community development, and more dollars that we can leverage to stimulate more private sector investment. So it's just this snowball that starts growing. As we have some successes, it just leads to more. And we want to improve quality of life. Quality of life factors are what makes a place a great place to work and play. And it is perhaps the most important decision and important investment you can have, because businesses choose locations based on quality of life. Quality of life is consistently ranked as one of the top, if not the top, reason why a community or a business would choose a particular community. And then finally, public infrastructure. Obviously, we can't grow the community without having the infrastructure in place for that growth to happen. But to achieve these goals, we need coordination. Coordination between businesses and entrepreneurs and the community and the government all has to work together with a common goal, which can sometimes be difficult.
Jessica, the only thing I would add to that is the common denominator across all 6 of those activities is the access to capital. It's very important.
Mm-hmm. So why is financing important? Obviously, money makes the world go round. It plays a huge role in economic development. Businesses need fairly priced long-term capital to grow and succeed. In this country, we have a huge long-term financing gap. And what I mean by that is businesses need long-term financing to fund fixed assets and increases in working capital, but banks don't necessarily want to lend long-term. Lenders are leery to lend long-term because it's risky. There can be interest rate changes, even specific business risk. So the company itself may drastically underperform, or the banks don't really have an out. So they're leery to make long-term investments, but companies still need long-term assets. So without long-term financing, companies aren't matching their sources and uses of funds. And so what I mean by that, they're often using short-term financing to fund long-term assets. And the example I like to give is we wouldn't purchase a home on a credit card, right? Because the interest rate's 24 or 25%. There's no way that would be sustainable. And the same is true for a business. If they don't have access to long-term financing, they're going to turn to short-term funds, credit cards, lines of credit, cabbage on deck, any sort of mode like that, in order to get their business done and to get the things that they need to do what they do, which often leads to a downward spiral. We also need financing to provide incentives to invest in communities. Developers need incentives. Otherwise, it's too risky. They especially need incentives for things like affordable housing. There are several programs that exist to assist with that. One that comes to mind would be the Opportunity Zone Tax Credit, which increases incentives to lend in distressed communities. Communities need infrastructure. They need infrastructure to attract workforces and businesses. There's always the chicken versus the egg problem. Do we develop the community and the amenities to generate the taxes, or hope that the tax base grows enough that we can then provide amenities? But again, one of the top 5 consistent reasons why businesses choose to relocate is because they are looking for quality of life, which generally means that they're looking for strong amenities and strong infrastructure. But the goal is to develop a working relationship between the government and the private sector to improve communities, because our resources are scarce, especially when we compare that to the private sector. Economic development, we can't provide all the capital. We can provide gap financing. So what can make a project happen that otherwise wouldn't happen? We can help assist in those. But we can't provide all of the money for every project. We can leverage other people's money using things like loan guarantees, or we can even provide incentive financing. So we can help reduce the risk by making subordinate loans. But communities can't provide all the money for every project. We do want entrepreneurs to have some skin in the game. We don't want them to squander the resources that they're given. But you must remember that once we invest in a project, that money is no longer available elsewhere. So we have to carefully consider our options to make sure that the funds are going to their most productive uses. So they're generally, they may not be mutually exclusive, but we have limited capital. So we're going to have capital rationing, and we can't just give money to every good project. We have to pick the best projects and invest wisely. So how do we encourage economic development? First, we can reduce development costs. We can have shovel-ready sites. We can have an adequate workforce within the area. We can have proper zoning and have all utilities in place. Another option would be to offer spec buildings or even discounted buildings, or provide loans for construction financing. Another way is to reduce the cost of capital. We know that businesses need fairly priced long-term financing, and we can assist with that through products like loan guarantees or grants, or even direct loans, which would be the least preferable because that ties up so much money. But most importantly, we can have relationships. We can have relationships with the private sector. We can have relationships with banks, so that way we can funnel good projects to them. Third, we can increase the amount of capital. We can attract private investment. One way to do that well is through loan guarantees. It puts very little capital at risk. We can stretch out terms. We're going to show here in a little bit, looking at the difference between reducing interest rates on debt and stretching out terms. And we're going to see that stretching out the term is often more beneficial than reducing interest rates. So the longer the term, the more manageable the debt service. So the debt obligation the company is owed. And because that debt service has been reduced, the company can afford to borrow more money. We can decrease operating costs. We can provide a skilled workforce. We can partner with a local college that can assist in training our workforce. We can have utility rebates, like energy efficiency or alternative energy tax credits. But the goal is to reduce the risk for the lender. We want them to feel comfortable lending, and to promote success for the borrowers. They need a manageable debt service with a small down payment, so that they have capital available to invest and to run their business properly. But not all economic developers have cash to lend. They may not have those sorts of resources, but they still have a vital role that they can play through education, through training, through assistance with loan applications, developing relationships with bankers, assisting with technology, or even helping to develop business plans. There's a whole host of things that you can do that requires very little resources in the terms of cash.
And just one of the additional things that they can do basically is understanding all of the public finance players that operate in the marketplace, whether it's SBA, USDA, EDA. All of those entities have field reps that have resources, and they want to deploy those resources. So I would encourage everybody that's operating in this space to make certain that they understand what federal programs are available.
Yes, to be that intermediary and that facilitator to help that relationship happen. Primarily what you are is relationship builders. You're building relationships between businesses, between the private sector, investors, and public sector to help cash get to its most necessary use to stimulate economic development. There are different ways that you can judge your efforts. One of the most popular ways is looking at leverage. How are you leveraging your private dollars? So how many private dollars do you get for every public dollar invested? Or job creation. How much money are you spending per job created? And so with that, it comes into a question of quality jobs as well. So if you're spending $150,000 to generate 15 $10 an hour jobs, that means that you spent $10,000 to generate each one of those jobs, which is not great money spent. But if instead you were spending $150,000 to generate $1,500,000 jobs, then that's different. You're spending $10,000 to generate $100,000 in revenue for your community. And a final way to look at that would be tax generation. What is your return on your investment? How many taxes are you generating due to that investment? What sort of return are you earning? Sorry. There you go. Okay, so I know that most of us here, we would love to have Amazon or someone like that come to our community, but most of us we're looking at small to medium-sized businesses. But that doesn't mean that they're any less important. The thing with small businesses is that money invested into small business stays in the community. We keep the taxes local. The money can go towards our schools, our libraries, our public services, and helps us to improve our quality of life. These independent businesses usually give back to the community tremendously. They're more likely to support local causes, to sponsor the baseball team, to provide more quality of life. And from a funding standpoint, that creates some difficulties because small businesses offer unique goods and services, and so that makes underwriting difficult. Loans are expensive to make. A small loan is just as expensive to process as a large loan. It takes the same amount of understanding. The underwriting costs are the same. The lender still has to understand the business. They still have to fill out the same paperwork. And if the banker isn't familiar with the community, that's a huge learning curve to understand, to process a small loan. So many large banks aren't super interested in lending to small businesses because the cost is so high in terms of an employee standpoint. They're putting as many man hours processing that small loan as they are the large loan. And there's a lack of a secondary market. Banks can't sell their small business loans easily. Banks want to recycle and relend and generate more closing fees. And so with the small business lending model, that loan isn't going to be sellable. And so the bank is going to have to keep that on their books. So it's expensive for them to keep it. That's also problematic for the borrower because of this uncertainty and the leeriness of the bank to lend to small businesses. That usually means that the loan will only be fixed for a maximum of 5 years. So the interest rate will fluctuate after 5 years. So that means that you have an unpredictability of payments. You don't necessarily know what your payment is going to be next year because it depends upon market rates. Long-term small businesses are very risky. Not only is it difficult to understand the business, but complicating that is rate risk. Offering a fixed rate loan is risky for the lender, and businesses need fairly priced long-term financing so they have something that they can plan for. The result, we see short-term lenders, things like Cabbage or On Deck. They have interest rates on short-term loans. Some even require daily rent. So what happens is good companies get poor financing, and their growth capital, their equity, is getting sunk into assets. The bigger institution gets, the less profitable they find it to be. I've worked with companies before or they're starting to, they can't get that financing that they need. They'll turn to credit cards or lines of credit, and all of this bad debt makes their credit scores tank. It also makes their debt to income too high. And so then banks don't want to lend to them. So it just perpetuates a problem. They just get deeper and deeper into a hole. I've sat with businesses before at community banks where the community banker has said, look, we believe in what you're doing. We understand, but you're going to have to pay off with these credit cards, and we're going to sit here in our office and watch you do it. We'll provide long-term financing to get rid of those. So that points out the problem with this mismatched sources and uses of funds. Rarely are these bad debts, this short-term debt, is it used to finance short-term needs. It's usually they see that a vital piece of equipment's gone down and they have to replace it immediately, or they don't have enough money to finish a project, so they're going to take out a short-term loan to get it finished. They're using long-term money to finance short-term needs. And I'm sorry, I said it backwards. They're using short-term money to finance long-term needs. And that often creates a downward spiral to even closure. Here we can see satisfaction rates for lenders. Unfortunately, most people don't understand the difference between a large bank and a small bank. I can't tell you how many times I've heard the woes from want-to-be entrepreneurs who have been declined from, the U.S. banks of the world. And when I asked them, well, have you talked to your local bank? Have you talked to the bank that's headquartered in your town? And they say no, they never even tried to get financing there because they assume that just because they got a rejection at one bank, they'll all have the same credit decision. Small banks, these community banks, they have received the highest satisfaction rates from small businesses amongst lending sources, but they have been declining in recent years. So the number of small banks declined over time. The reason why we care about this is because community banks generally have a larger share of small business loans versus a large bank. And small banks are able to make quicker decisions. Generally, the decision makers are in the same house as the lenders. They have a lot of flexibility. The loan officer has access to the president. They have meetings every week. The community, all decisions are made under one roof. And so the projects are able to go through much easier. I just spoke to one of our larger community banks in our area last semester. We did an interview with her, and she said that they're able to have such success because they're not trying to fit square pegs into round holes. They're not trying to answer questions and get the information that they need and make them fit into a predefined type. I mean, there are the large a lot more resources than the small banks, so they often have larger online presence and more things that you can do remotely. But getting them to understand in your community can often be difficult. So here we can see this is a picture showing the size of the bank relative to county population. And here we see that there's a large concentration here in rural areas. So in small populations, community banks serve the most rural areas across the U.S. They're primarily headquartered counties under 50,000 in population. Consolidation, however, is eliminating these local banks, which means that there will be a lack of specific community knowledge, which means that entrepreneurs will not be able to get the financing that they need. So here we can see consolidation. So this is year over year consolidation. Words, I can't see the final year. But we see that the year started with 4,750 community banks and ended with 4,588. Consolidation is eliminating local banks. They're consolidating, they're being purchased, or even closing. The average community bank consolidation rate in the last year was 3.5%. Last year it was 4.7%, so it's slightly better. In our region, Missouri, Alabama, and Tennessee had rates above 4%, which is the median for the country. So they're closing. Small businesses are being squeezed because they can't meet conventional lending requirements from big institutions. They're turning to fintech lenders, which often charge higher interest rates and have shorter terms compared to what a community bank would offer. Why are they going away? First would be regulations. Regulation burdens are tremendous. The Conference of State Bank Supervisors had a paper last semester that said that community banks' largest expense was regulatory burdens, complying with regulatory burdens. So they're closing due to that. Another problem is talent gap. Most people don't come to school wanting to be a banker. It's often an overlooked career and sometimes difficult to find people that want to become a banker. So I work with the Kentucky Department of Financial Institutions, and I was talking to the chairman, and he said that their number one thing that they look at when they go do bank visits is their succession plan. They want to know who's going to take the reins next, where they're coming from. And with that, they only have one of two choices. They can promote internally or they can hire a headhunter. But the purpose of this is that community banks know their community. They're able to make loans on information that can't be found in a business's financial statement. And remember, large loans are just as costly as small loans, and small businesses have a lot of unique information that is costly to understand. So because of this, community banks are able to make more informed loans and have lower default rates. They're relationship banks, and they're flexible. Yes.
Yeah, one of the things that we're seeing proliferation, here across the Carolinas is the advent of the credit union. Well, what we're finding is the credit unions are starting to participate a lot more in the commercial lending aspect of things before. I mean, traditionally, they finance homes, they finance automobiles, but what we find now basically is they're trying to seek out those small entrepreneurs that need the type of financing that a traditional community bank would provide. So a lot of entities, a lot of companies, a lot of small businesses are defaulting to the credit unions as an alternative source as well.
Yes, which is actually one of the reasons why community banks are closing, because credit unions aren't subject to stricter regulations as community banks. And so oftentimes most people I speak to anyway don't think about turning to a credit union for a business loan. So that would be another point that could be shared. Here we see that this consolidation in banking is increasing at the fastest rate in small communities. The slide's cut off on the bottom, but the smallest community size is on the left-hand side. I didn't notice that before, I'm sorry. These communities already lacked banking options. Many of them are in banking deserts. Most banking deserts, which means that there's less than one branch per county. Most of those are in the West, but there are some areas in our region, specifically the more rural regions or ones that are on the verge of becoming a banking desert. So they don't have banking options is what I'm trying to say. And we're seeing the largest closure in those areas where banking options are already limited. So it's making it even more difficult to get their needs fulfilled. It's harder to get day-to-day banking needs completed, especially more hard to get more specialized loans. So it just makes it more difficult for Mid-America to thrive. One thing that I do want to point out that banks are very aware of is the Community Reinvestment Act. The Community Reinvestment Act requires banks to provide banking services to their entire region and to all people, regardless of ethnicity, wealth, socioeconomic background. They're required to limit to all community members. And so they are tested on this. The FDIC, the Federal Reserve Board, and the OCC divvy up banks, and they test them on their ability to provide services to their entire region and to all people. There's some different components within the CRA examination itself. There's a lending component, an investment component, and a service component. So they're wanting to make sure that all populations are receiving funding, that they're making investments in the community across the board, and they're providing services equally across their region. And so with this, there's the punishment for this is that banks aren't allowed to open new branches. They may not be allowed to merge or to expand. So banks are very aware of the Community Reinvestment Act and of their CRA rating. And so they are looking for investments to make in distressed areas and low income opportunities. So it is something that's on their radar, and it's something that you should probably have a discussion with your local banks for to see what needs that they have, to see if there's any opportunity there with the projects that come across your board. Businesses, they need financing for working capital. This is encompassing your current assets and current liabilities. So your accounts receivable or your inventory. So it means that the company is growing. They may need money for fixed assets. They may want to expand or to purchase new equipment or have a new product line, or even to pay obligations, so debt or trade credit. But the thing is you have to match your sources and uses. Long-term funds for long-term assets. It's easy to fall into mismatched sources and uses of funds. If it, like, for example, if a business needs a new asset and they choose to purchase that on their line of credit, the bank always has the option to cut that line of credit. The result is an implosion. All of a sudden, they have this huge debt burden that they have to pay back. They don't have the access to where they're scrambling, looking for funding to cover this purchase. So it can create a lot of problems. So whenever we're looking at businesses and different investments, different investment opportunities, we're looking at both quantitative and qualitative information. So we're not going to look at the numbers in isolation, but we're not going to just talk to the guy and see if he's nice. We're going to take both together and make sure that we're investing in a sound business. We're wanting to see, we're wanting to know, what do you know about the deal? Is the business willing to provide personal and business financial statements? Is the financial information credible? How was it prepared? Was it prepared by an accountant, or was it thrown together on QuickBooks? Will they let you talk to their customers and suppliers to talk about product chains and to see how customers like the product? How do they respond to devil's advocate questions? Is the answer always someone else is in charge, or it wasn't my fault? Are they looking for free money from the government? That's what I hear the most is, well, I want an SBA loan because I hear that they give out free money. I've heard that so many times. Do they have a realistic assessment of their market, of their competition, and of their job creation potential? And remember that when you're working with these individuals, they're entrepreneurs. They're always going to be optimistic. So they're going to over believe in their product, their market, and their ability to produce. And are they willing to spend any money up front? Do they have any skin in the game? Have they spent money on appraisals, on environmental reports, on market analysis? There are some red flags that you can look for. Any abrupt changes in management style, or if there's been any key management resignations or changes. Are they able to provide timely financial information? Have they frequently changed accountants, or have they downgraded the quality of their financial statements? So for example, have they switched from audited to reviewed, or from reviewed to compiled, or from compiled to in-house financial statements? Are they able to meet their scheduled appointments and commitments? Are there any tax liens? Are there any civil suits or foreclosure deeds or mechanics liens? And finally, do they own a lot of plug-in equipment? So can they just unplug it and move? Plug-in equipment is equipment that can be moved quickly versus permanent fixtures. So it's just different things to keep your eye on when looking at different deals. When you look at business history, who are the managers? Do they have any skin in the game? Do they own any company stock? Have they invested in the company? Is the business offering a unique good or service, or is there a lot of competition in the marketplace? How long have they been in business? Do they have a long track record? Does the entrepreneur have any business history? Do they have a succession plan? If there isn't a succession plan, often the bank will want to be named on their insurance policies.
Jessica, when we're talking about the last two slides, I think for the EDOs that are here on the cast, this is probably targeted toward your existing industry clientele for the most part, where you have an existing industry program. These are sorts of things that you're going to want to have to delve into to make certain that you fully understand, so that you can help your existing industry grow and thrive.
Yes, sir. So finally, we get into the numbers, which I know is a love-hate relationship. Some of us love it and some of us hate it. What I usually hear is, oh, we have a guy for that. Right. We have a guy who looks at the numbers and tells us, yeah, thumbs up or thumbs down, but we really need to understand how to look at a company's financial statements. So once we've looked at a business and we've talked to them about the project, and we understand what they're trying to do and what the current competitive climate looks like, and we think, okay, they have a good case here. This seems like a good idea. Let's look at the numbers and let's look at their projections and their historical numbers and see if it actually makes sense. We can calculate financial ratios once we spread the numbers and compare them to the company itself over time to see if it's grown, or even to the industry. There's different places you can find industry information, like Dunn and Bradstreet or RMA or the SBA. Mergent is an access you might have. It costs something though, or even trade associations. The thing with financial ratios though is probably going to raise more questions than answers, which is good because it gives you more informed questions to ask to those business owners. So it gives you more thoughtful, intelligent questions to ask once you go to a site, especially if you notice maybe there's a problem with inventory ratios. It's different in the industry, and then you get to the company and you notice, oh well, there's 2 inches of dust on their raw materials. Well, now you really have a case of, well, what's happening here? Did you buy excess inventory a few months ago so that way you could take advantage of a major price discount, or are you having problems selling through? So it just gives you more informed questions to ask. But one thing to take away from with financial ratios is that there isn't a single ratio to look at. We can get a picture of the general health of a company by looking at ratios together, and it can help us identify areas of weakness, but we can't just pick a single ratio out and say, oh, look, here's the problem.
And also you want to, take a look at the trends that are associated with those ratios as well.
Correct. Yes. And you can find those trends again online. Risk Management Association or Dunn and Bradstreet have quite a few. The SBA does as well. So there's some different financial reports to look at. And I'm sure most of you have heard of these, so we'll go through them fairly quickly. There's a balance sheet, which basically tells us what the company owns and how they got it. So it's assets equal to liabilities plus equity. The right side, the liability and the equity, is telling us how we got the assets. It provides an overview of our finances at a moment in time. So it's like a snapshot, a picture. It's going to tell us everything we own and how we got it. It's going to help us answer questions like, has the company taken on too much debt? Do they have illiquid assets, or do they have enough cash on hand? The profit and loss statement, also known as the income statement, shows us whether or not a company is making a profit for over a period. It helps us to look at trends, to see, to forecast what's going to happen in the future as well. And we can calculate financial ratios from these. It is important to know what type of accounting practice is being used, whether it's cash-based or accrual. Cash-based accounting is going to be seen primarily in smaller businesses because it's easy to compile and easy to record, but it's less accurate, and it generally overstates the health of the company. So it's immediately recognizing all expenses and income. Accrual is more accurate, but it's difficult to compile. So with that, we have to differentiate between unearned revenue and prepaid expenses. So the revenue is accounted for once it's actually earned. And so that's something just to be aware of. Here are some different financial ratios that I picked out. I thought they were important. Sales growth, this is just showing us increases or decreases in sales over time. Cost of goods sold over sales tells us, is our cost of goods sold stable or increasing or decreasing over time? Gross profit over sales is looking at the stability of our gross profits. Operating expenses to sales is looking at the stability of our operating expenses. So most of this is just looking at how things have changed relative to sales thus far. Our current ratio is current assets divided by current liabilities. It's giving us a measure of liquidity. We're looking to see, are there enough short-term assets to pay bills when they come due? Generally, we want that to be greater than 1. We want to have more current assets on hand than current liabilities. Current assets are those assets that we expect to convert to cash within 1 year, and current liabilities are bills we expect to pay within 1 year. A more restrictive measure of liquidity is the quick ratio, which just deducts inventory from the current assets. We often want to look at quick ratio because it is more conservative. And if there's a problem with your current assets, it's usually based in your inventory. So if you have a lot of things on hand that aren't selling through, the quick ratio would give us a better, more realistic measure of liquidity. Working capital is just the difference between your current assets and current liabilities. So this is important when you're thinking of inventory management and accounts receivable management. Debt to equity, debt over equity, is looking at our level of leverage. How much of our business are we using debt to finance? Days receivable, it's looking at our accounts receivable but relative to our sales. Days inventory and days payable, they all go together to help us calculate our cash to cash cycle and our operating cycle, which is generally just looking at the efficiency of a business. But again, quantitative analysis cannot be done in a vacuum. So we need to do qualitative analysis as well. We need to make sure that we're doing site visits, interviews, industry analysis, looking at economic trends, as well as doing our financial analysis. No two people are going to review a deal and get the same conclusion. So that's one of I teach economic development finance at Murray State. And one of the most difficult things is trying to get students to understand that it's okay that their answer doesn't look just like mine. They're so used to having right or wrong answers. And there is, a window of right and a window of wrong. But no two people are going to have the same exact conclusion on a deal. The numbers are not going to lie, but they can hide the truth. A ratio that's out of line is an indication of a problem. It doesn't mean that there is for sure a problem. So with these, I generally tell my students to give them a window, to try to set up a window that is fair, and to look and see how they have changed over time, how the company's changed over time, or how it compares to the industry is going to give you a better analysis rather than just looking at a number. Sorry, go ahead.
I think additionally, Jessica, when you're talking about, you can look at trends in the company over time to determine whether or not what you're looking at is actually accurate. When you're looking at a financial statement, it's like a roadmap. It'll tell you where you've been, and it can tell you where you're going to go. Back, years ago when I was in the banking business, I could do an analysis of a financial statement, and I can tell, what happened to that business over the course of a year. And they would ask, the borrower, can you tell me what happened in your business? And if you truly understand, the nuances of your income statement and your balance sheet, we should be on the same page. But typically and often you aren't, to your point earlier, that they don't truly understand what their numbers say. But if you take a look at trends over a number of ratios, you can get a feel for what's actually happening within that enterprise.
Exactly. So if there's a project being proposed, we need to look at the project costs. The first step is to estimate our project costs, but remember that entrepreneurs are optimists, and so they always underestimate the negative. Mm-hmm. And there's a lot of things that that can fall under the radar or is overlooked. Things like contingencies, construction contingencies, especially if it's for rehabilitation. Those often get overlooked, even though everything always goes over budget. Any offsite infrastructure that might be needed, or soft costs. So if you're needing engineering reports or appraisals or environmental reports, closing costs, surveys, any interest that you pay on the loan during that construction period, any legal cost, or even the working capital necessary. So lots of things can fall through, and we need to look and get a detailed breakdown of how any funds will be spent. And then second, we need a timeline. But again, entrepreneurs are optimists, and they're going, it will always take longer than what they expect. And one thing to always keep in mind, though, is that some businesses tend to focus on what a program or a lender will finance rather than what they need. So we need to make sure that what is being asked for and what is being done is actually in line with the business's needs rather than trying to fit someone else's criteria.
And one other thing I think that is notable to point out is you're going to have hard money financing and you're going to have soft money financing. And typically the bank's going to want the borrower to cover the majority of the soft costs, and that may be architectural engineering, and they will focus more on the hard costs, which is equipment and the fixed assets.
Right.
In most cases.
Because they want collateral. Yeah. So the bank is going to want collateral. There isn't any collateral with soft costs.
Right. Exactly.
There's nothing the bank can get back
right.
if they finance soft costs.
Yep.
So they, the bank is not in the business of owning assets, but they also don't want to lose money. So they're going to make sure that they cover themselves. When you're trying to get financing, the first step is to get private money. That would be the goal for everyone, right? We don't want to use our resources if we don't have to. But if private funding fails, we need to identify the gap. The gap. What do I mean by the gap? I mean, what is keeping this project from happening? Where is the fail? Like, if we stretch out the terms and got a lower rate, could this happen? Or if they just needed a little bit more money, or whatever is keeping a good project from happening would be the gap. And then we fill that gap with public sector financing. It is important to understand your lender. Take the time to understand their language, to know what the terminologies that they use are, to understand their risks and to know their limitations. So debt is money that's borrowed. It's calculated on a predetermined schedule. It may be fully amortized, partially amortized, or interest only. If it's partially amortized or interest only, that means there would be a balloon payment upon maturity. Fully amortized means that you're paying interest and principal over time, and when that loan reaches maturity, the debt is paid off. Debt is typically secured by the assets being financed, and we can use a constant table that I'm going to show you in a moment to determine our debt service schedule. Equity is money contributed by the owners. It may never get paid back. There's no fixed repayment schedule. It's slow, patient money. It is the equity holders are paid back once all debt obligations have been met. The nice thing about equity, it is more expensive than debt because the interest on debt is tax deductible, but it does free up the assets to borrow money. So if you purchased an asset with equity, you could then borrow money against it or use it as collateral when getting a loan for something else. But when you're looking at the income statement, the last line is earnings available to common shareholders, or net income. And that is the money that is available to those equity holders at the end of the day. So they are last in line to receive anything. They're exposed to the greatest amount of risk, but they also have an unlimited reward. So here's a picture of a constant table. And I know that for some of you, you're thinking, oh crap, I didn't sign up for math. It's not so bad, I promise. Here we see just different constants related to term. So the term is on the vertical axis and the interest rate is on the horizontal. So for example, if we wanted to look at a loan that was at 5% with a term of 5 years, we would look at the intersection between 5 years and 5%, and there is our corresponding constant for that loan. We multiply that by our loan amount, and that gives our debt obligation. So the debt service required for that loan. So let's play with this a little bit. Oh, my interest rate here broke off 13.5%. So if we were to look at loan terms and loan rates, we could just calculate these, and it won't take very long. We look at the intersection between 5 years and 5%, and we get 0.2265. If we look at the intersection between 5 years and 10%, that just goes out a little further to 0.255. Look at the intersection between 5 years and 13.5%, that's 0.2761. And we can quickly fill these out. 0.1273, 979. I have terrible handwriting, I'm sorry. And then 0.792. I'll try to write it neater. 0.792. All I'm doing is looking at the intersection between 10 years and 10% and see it's 0.1586. Knowing this constant table is like having a cheat sheet when you're talking to the lender. You know what their magic, what would work. You know how it gives you negotiation power with that lender.
1290 and 1158.
So if we had borrowed $100,000, all we have to do is multiply that 100,000 by our constant. So here for the 5 years at 5%, our debt service is $22,650. All I'm doing is moving that decimal. 25,500, 27,610, 17,270. I'm just going to fill out a few of these here. You guys get this.
47.
So the main thing I want to show here is that does reducing interest rates help us a whole lot on an annual basis when we're thinking about spending cash flow? Or does increase it more? Here we see that, you know, they want to make sure they get the lowest interest rate possible. But from going from 13.5% to 5% on a 5-year loan, we're only saving $5,000 a year. If instead we said, well, let's keep our rate at 13.5%, and let's go from 5 years to 10 years or 15 years, we're saving $12,000 a year in our payment. That's freeing up cash for the businesses to use. Especially if we say, okay, well, the bank offered us 13.5% at 5 years, or even over here, this would be the highest debt obligation. Over here's the highest debt obligation. If we get a lower rate and more years, then look how much money we save. But the main point of this is that we're getting more bang for our buck when we negotiate longer terms rather than lower interest rates. The business is able to keep more cash flow available for their operations if they're letting less money go out the door for debt service. And most businesses aren't terribly concerned with the interest that they're spending anyway, because that interest is tax deductible. So they would much rather have a lower monthly obligation that they can meet easily rather than saving money on interest, because again, that's tax deductible. So what happens as rates decline? The payments decline. What happens when the term increases? The payments decline, but the term has a bigger impact on the payment than the rate does. But what about collateral? Banks care about both. They want to make sure that you have the cash available to service that debt so that you can make those obligations as you have promised. Banks don't want to be asset holders. They want you to repay the debt as promised. But to cover themselves, they are going to require collateral. Banks want you to be able to afford the debt that you've agreed to. So they're going to ask for a debt coverage ratio of 1.1 to 2. And they also want the assets that you're borrowing against to be able to cover that debt obligation in the event that you don't pay. They're going to require a loan to value ratio less than 100%. So they're going to usually around 80. They're going to discount the value of your assets so that in the event that you don't pay, they can sell that asset and get their money back. And they'll lend a lesser amount as determined by using those two numbers. So here's an example. Let's suppose a company has profit after tax of $65,000. They have depreciation of $35,000 and they're looking to purchase a new building for $600,000. They have a down payment of $100,000, so they're wanting to finance the remaining $500,000, and the bank requires a debt coverage ratio of 1.2. Is the bank likely to approve the loan if the business is creditworthy? The credit terms offered are 8 years at 7%. So let's find how much money do they have to service that debt? How much cash flow do they have available for debt obligations? To calculate this, we're going to look at their profit after tax of $65,000. Add to that depreciation of $35,000. And divide by the debt coverage ratio of 1.2. And I got $83,333. We can look at the constant table and multiply that by the amount being lent, that $500,000, to calculate our debt obligation. How much are we having to pay? So we have $83,333 available to pay on our debt every year. Can we afford this debt? So we're borrowing $500,000, and we multiply that by our constant that we get for 8 years at 7%. And you guys can correct me if I'm wrong, but I looked at it and I saw 1636.
1636, yeah.
Thank you. Correct. And that means that our debt obligation then is $81,800. So because the $81,800 is less than the cash that we have available, the $83,333, then we can afford this. Right. So the bank would say yes, because we're borrowing only 80% of value, and we have excess cash to cover our debt obligation. There is kind of a trick you can do here. If you look at the cash flow you have available for your debt service, this $83,333, and you divide it by the amount you want to borrow, the $500,000, then that's going to give you a constant of 0.167. And so the trick is, as long as the constant is less than 0.167, it works. So it gives you some negotiation power. So now you know the bank, you know what the bank's looking for. You know, if I can find a constant for less than 0.167, I can negotiate. So the bank has offered us 8 years at 7%. Let's go scroll back here. 8 years at 7%, that gets us 0.1636. But we know that for any number less than 0.167, then they would say yes. So we could look back here and we could say, okay, well, what about 4.5% for 7 years? Or what about 15 years at 13.5%? We know the magic number. So we can negotiate different terms that would still allow this project to work.
One thing I might add to your point, Jessica, is banks want to lend money. They just want to mitigate.
Right.
They want to lend money. They want to make sure that you have the ability and the capacity to service the debt, and they want to minimize their risk. So don't be afraid to, as a company, to want to borrow money, because that's what they exist for.
Yes, to want to borrow money, not only because debt is cheap, because you're getting to reduce your tax burden, but also because you get to retain equity. So you still get to maintain control of your firm. And I mean, with debt, there may be some covenants within that restrict some movements, but they're generally non-binding for a healthy company. Finally, we need to review the 5 C's: credit, collateral, character, cash, and condition. Capacity, or the credit history. That is asking us, does their historical track record demonstrate an ability to manage their debt service obligations? Will they repay? And we need to understand their existing repayment priorities and what are the existing debts of the company. Collateral. Does the borrower have adequate collateral to secure the loan? If it's a startup, you may be using the personal assets of the owner as collateral. The collateral is discounted because, again, the bank does not want to be a property manager. Are the project costs reasonable? And we may need to look at the liquidation value of the machinery and equipment, especially if it's specialized, rather than the full value. Character. Does the borrower have the capability or the maturity or the character to repay that loan? But even with the best borrowers, there is always some risk. I don't know if you've heard of the 4 Ds of disaster: death, divorce, drugs, disability. The 4 Ds of disaster can even ruin the best of the borrowers. With this, we can assess their character by looking at credit reports, doing site visits, looking at their background information. Cash. Do they have enough operating cash flow to repay the loan? We need to make sure the cash flow is greater than the debt service that they've obligated themselves to. With this, we're looking at actual existing cash, not projections. And then finally, condition. What is the purpose of the loan? What is the amount being borrowed, and what are current rates? Our first goal should always be to find and establish a relationship with a private bank. We only fund the project with equity and bank financing when we can, and we use public sector gap money when appropriate. We've talked about what businesses want. Businesses want long-term funding. We looked at that debt service calculation, and we saw that the longer the term, the lower the payment. They're wanting to make sure that they're not using their working capital and their short-term money to fund long-term projects. They're looking for a fixed rate. They want predictability. They want to know what their payment's going to be tomorrow and in 15 years. They want a low down payment because that will be contribution, and they want a low interest rate. If they have to pick, they would prefer longer term rather than lower rates, because again, that protects that operating cash flow. Banks prefer short-term lending because it helps them reduce and manage their risk, whether that's collateral risk, maturity risk, rate risk, or credit risk. They prefer floating interest rates. They want the repayment to vary with the bank's cost of the money. They prefer a high down payment, which gives them better loan value ratios, and it demonstrates owner commitment. And they want higher interest rates because it means more profit at the end of the day. So we see how they're both on opposing ends, and we're trying to negotiate what would work best for both. But we need to determine what role public financing is going to play. If there is a gap, we need to identify that gap. We need to determine if it can be closed with public financing, and identify any available programs that would work for a particular company. So there's different types of gaps that can exist. A credit gap just is the borrower's inability to demonstrate their ability to repay that loan. Maybe it's a new product or a new service that has no record. A cash flow gap, they just have an inability to repay the debt. One solution to that would be to lengthen the term, because again, then they have more cash flow available each month, and it reduces their monthly burden. And a capital gap. So they have limited borrowing power. Maybe they have poor credit scores, or they have high debt to income, and they just can't borrow as much as they need. But all of these are gaps that exist that basically mean that if they don't get those filled, the project won't happen. Even if it is a good quality project that's going to bring good paying jobs to your community. So with this is where we shine, where we can come in and help offer solutions to these businesses and help them to get that gap financing that they may need. Public sector financing is designed to help banks make loans to businesses. It does not replace bank financing. There are different types of programs. We have loans or grants or low interest rates and long terms. We can offer subordinated financing or even loan guarantees to decrease lenders' risk. It does, if you can work with a bank, it does help them to meet their CRA requirements again, circling back to the beginning. So banks want to make these loans. That's what they're in the business to do. They want to make loans, but sometimes the risk is too great. If we can help for some of that risk, that bank wants to lend, and they're rewarded for doing so with better CRA grades. There's different types of public sector programs. We have direct loans that provide money. They're not sustainable because once that money is used up, it can't be used elsewhere. And it takes a long time for that money to be replenished. You would have to have a tremendously large fund to have a revolving loan fund, or it has to be huge. Usually, these direct loans provide up to 40% of project costs and offer subordinated financing, and they may help finance real estate or equipment. Loan guarantees just simply assure repayments to a bank. So they're providing additional collateral, additional guarantees, and they usually guarantee 75 to 80% of the bank's loan. So they're not going to guarantee 100% of the loan because they want the bank to do solid underwriting. And this would enable the bank to lend to younger companies, more risky companies, startups. Public programs do not compete with banks, they partner with banks, which is a big takeaway here. We're not looking to replace a bank, we're working to work with banks. Just a few cautions. There is no free money. Public programs usually have strings. They require a minimum number of jobs to be created, an increase in job opportunities. There may be geographic limits or fixed timetables or limits on the uses of funds. They usually take a lot longer than they say that they will, and there's lots of paperwork. Just downsides there. But remember that deals do fall apart because project costs escalate. Financial positions deteriorate. There may be a change of ownership or control. The lender may choose not to use public sector financing. The project may become too burdensome or too costly, but loan covenants can help. That does allow the bank some control over what the company chooses to do. Chuck, did you want to add anything?
The only thing I would add is relative to the public sector finance partners. Make certain that you know who they are. I mean, we're talking about SBA. They have a number of programs that are available to assist, where they can provide gap financing. You have USDA, where they have funding for both large companies and for smaller intermediaries. You have EDA, who has, because of ARPA funds, they have a ton of money that they've been putting on the street of late for, both hard money finance and for public infrastructure. So all of the alphabet soup of entities that provide financing of some kind, if you have a rep in your community, if you've not met them, I would encourage you to do so, because they can make a difference between a deal happening for an existing industry and not.
Absolutely. Here's my contact information if you have any questions, and here's Chuck's as well. Feel free to reach out to me if you would like to discuss anything further. I'd love to help.
Well, thanks, Dr. Dunn. And Chuck, what a great session. We have just a few minutes. If there are any questions, you can pop those in the chat and I can read those to our experts here. If not, we'll give you a little bit of your time back. We did have one question that came in on if the slides will be available. The answer is yes. Shortly after, thanks Dr. Dunn too. Shortly after this closes, we will send slides to all registrants. We will also, it'll probably be a tomorrow thing. It'll take us some time to package this up. We'll make this available on our webcast page. So if you go to SEDC's website, sedc.org, pull down the publications tab, you'll see SEDC webcast. So this recording will be there as well. So it looks like no questions. Let me invite everyone to join us in Atlanta for Meet the Consultants, our American South Site Selection Summit, 60 some plus speakers, a great network of globally active site selectors will be present with us on the ground and also delivering good educative content. So this will be a really good event, May 8th and 9th in Atlanta. You can visit the website if you'd like to register for that. So with that said, Dr. Dunn, Chuck, thank you all so much. This was so informative. Appreciate your time. And any last words before we go?
I would like to share that if anyone's interested in further education, Murray State does have an economic development master's degree that we're now offering, which can be completed online. And with that, you could even get 12 hours transferred if you have any graduate courses in a related field. And we do give credit for work experience as well.
Thanks, Dr. Dunn. I meant to say that on the front end. Murray State is home to one of the very, very few Masters of ED programs in the entire country. So we're certainly thankful to have them in the SEDC network. And also, we want to say thank you for Murray State for joining SEDC as well. We can't wait to work with you all going forward. This is just one of many opportunities like this. So thank you for that. Thank you, SEDC members. Have a great week and great weekend.